The Forex market is a very big place. It is where money from different countries is traded. Think of it like a giant global market. People and banks buy and sell currencies here. This market is also called FX. It stands for foreign exchange. You might have used it without knowing. When you travel to another country, you change your money. That is part of the Forex market. It is an exciting world for many traders. This market is the largest in the world. Billions of dollars are traded every single day. It is much bigger than the stock market. Many people, banks, and companies trade here. They trade for many reasons. Some trade to make a profit. Others trade to do business in other countries. The Forex market never really sleeps. It is open 24 hours a day. It is open 5 days a week. This makes it very active. Why is the Forex market so popular? One reason is that it is very accessible. You can start trading with a small amount of money. You can trade from your computer or phone. Many online brokers offer Forex trading. This makes it easy for anyone to join. Another reason is the chance to make money. Currency prices change all the time. Traders try to guess these changes. If they guess right, they can make a profit. Forex trading might sound complex, but the basic idea is simple. You are betting on the value of one currency. You bet against another currency. For example, you might think the euro will get stronger. You think it will be stronger than the US dollar. So you would buy euros and sell US dollars. If the euro does get stronger, you make money. We will learn more about this soon. This guide will help you understand. In Forex, you always trade currencies in pairs. You cannot just buy one currency alone. You must exchange one currency for another. Think of it like buying apples at a store. You give money and you get apples. In Forex, you give one currency and you get another. These pairs have names like EUR-USD, this means Euro and US dollar, or USD-JPY, meaning US dollar and Japanese yen. There are many pairs. Each currency pair has two parts. The first currency is the base currency. The second currency is the quote currency. Let's look at EUR-USD again. Here EUR-Euro is the base currency. USD-US dollar is the quote currency. The price of the pair shows you something. It shows how much of the quote currency you need. You need it to buy 1 unit of the base currency. It is like a price tag for the base currency. There are many currency pairs to trade. Some are traded more often than others. These are called major pairs. Major pairs usually include the US dollar. Examples are EUR-USD, GBP-USD, and USD-CHF. GBP is the British pound. CHF is the Swiss franc. These pairs are very liquid. This means many people are buying and selling them. This makes trading them easier. Prices move smoothly. Then there are minor pairs. These pairs do not include the US dollar, but they include other major currencies. For example, EUR-GBP or EUR-JPY. These are also called cross-currency pairs. There are also exotic pairs. These include one major currency and one currency from a smaller economy. For example, USD-SGD, US dollar, Singapore dollar. Exotic pairs can be riskier. They are not traded as much, so prices can jump around more. Forex trading is about buying and selling currencies. When you trade a currency pair, you do two things. You buy one currency in the pair, at the same time you sell the other currency. This might sound a bit confusing at first, but it is like an exchange. Imagine you have US dollars, you want to buy euros, you are selling your dollars, you are buying euros with those dollars. Forex trading is very similar to this simple idea. Let's use an example with EUR-USD. Suppose the price of EUR-USD is 1.1000. This means 1 euro costs 1.1000 US dollars. If you think the euro will get stronger, you buy EUR-USD. This is called going long. You are buying euros. You are hoping the price will go up. If the price goes up to 1.1100, you can sell. You make a profit on the difference. It is a small difference per euro, but traders use large amounts. What if you think the euro will get weaker? What if you think it will be weaker than the US dollar? Then you would sell EUR-USD. This is called going short. You are selling euros. You are hoping the price will go down. If the price of EUR-USD falls to 1.0900, you can buy back. You make a profit on this difference too. So you can make money when prices go up. You can also make money when prices go down. This is a key feature. Trading happens through a Forex broker. A broker is a company. It gives you a platform to trade. You open an account with a broker. You put money in your account. Then you can start trading. The broker shows you the current prices of currency pairs. You decide when to buy. You decide when to sell. The broker helps you make these trades. They usually charge a small fee for this service. We will talk more about brokers later in this guide. Currency prices are always changing. Many things can make them move up or down. Understanding these things is very important for traders. One big factor is economic news. News about a country's economy affects its currency. For example, if a country's economy is strong, its currency might get stronger. People will want to invest there. They will need that country's currency. This demand pushes the price up. It is a basic supply and demand rule. Interest rates are another huge influence. Central banks in each country set interest rates. If a country raises its interest rates, its currency often becomes more attractive. Investors can earn more money holding that currency, so they buy more of it. This makes the currency stronger. If interest rates are cut, the currency might get weaker. Traders watch central bank meetings very closely. They listen for clues about future rate changes. These meetings are very important events. Political events also play a big role. Stability in a country is good for its currency. Elections, political unrest, or big policy changes can cause uncertainty. This uncertainty can make a currency weaker. Investors might worry about the future. They might sell the currency. This makes its value go down. So traders need to stay aware of political news. News from around the world can affect prices. It is good to read news regularly. Other factors include inflation. Inflation is when prices for goods go up. High inflation can be bad for a currency. It means the money buys less. Natural disasters can also have an impact. So can big international trade deals. Even just market sentiment can move prices. This is what traders generally feel about a currency. If many traders are optimistic, prices might rise. If they are pessimistic, prices might fall. It is a complex mix. Section 5. Decoding Forex lingo, pips, lots, and spreads explained. When you start trading Forex, you will hear new words. These words might seem strange at first, but they are important to know. One common word is pip. A pip is a very small measure of change. It measures the change in value between two currencies. For most currency pairs, a pip is 0.0001. For example, if EUR/USD moves from 1.1050 to 1.1051, that is a 1 pip move. For pairs with Japanese yen, a pip is 0.01. It's like a tiny step. Another important term is lot. A lot refers to the size of your trade. In Forex, currencies are traded in specific amounts. These amounts are called lots. A standard lot is 100,000 units of the base currency. This is a big amount. But don't worry, there are smaller lot sizes too. A mini lot is 10,000 units. A micro lot is 1,000 units. Some brokers even offer nano lots. These are 100 units. Choosing the right lot size is key for managing risk. Then there is the spread. The spread is the difference between two prices. These are the bid price and the ask price. The bid price is the price at which your broker will buy the base currency from you. The ask price is the price at which your broker will sell the base currency to you. The ask price is always a little higher than the bid price. This difference is the spread. The spread is how brokers make money. It is like their commission. Understanding these terms helps you trade better. When you see a price quote like EUR/USD 1.1050, 1.1052, you will understand. The first number, 1.1050, is the bid price. The second number, 1.1052, is the ask price. The difference here is 2 pips. This is the spread. Knowing about pips helps you calculate profit or loss. Knowing about lots helps you control your trade size. These are basic building blocks for your trading knowledge and future success. Section 6. Getting started, your first steps in Forex trading. Are you ready to start your Forex journey? The first step is to choose a Forex broker. A broker is a company. This company gives you access to the Forex market. There are many brokers to choose from. It is important to pick a good one. Look for a broker that is regulated. Regulation means a government agency watches the broker. This helps protect your money. Also, check their fees and spreads. You want low costs. Once you choose a broker, you need to open an account. This is usually done online. You will fill out an application form. You will provide some identification documents. This is normal. After your account is approved, you can deposit money. Most brokers offer different account types. Some are for beginners with small amounts. Others are for experienced traders with large amounts. Start with an amount you are comfortable losing. This is very important advice. Many brokers offer a demo account. A demo account is a practice account. You trade with virtual money, not real money. This is a great way to learn. You can practice making trades. You can learn how the trading platform works. You can test your strategies. All this without risking any real money. It is highly recommended for beginners. Spend some time on a demo account. Get comfortable before you trade with real funds. This will build your confidence greatly. After practicing with a demo account, you might feel ready. You can then start trading with real money. Start small. Do not risk a lot of money on your first trades. Forex trading involves risk. You can lose money. So, it is important to be careful. Learn about risk management. This means learning how to protect your capital. We will discuss some tips later. Patience and learning are your best friends. Forex trading is a marathon, not a sprint. Section 7. Basic Forex trading strategies for newcomers. When you start trading, you need a plan. A trading strategy is your plan. It tells you when to buy, it tells you when to sell, it also tells you when to stay out of the market. There are many complex strategies, but beginners should start with simple ones. One basic strategy is trend following. This means you look for a clear trend. Is the price generally going up, or is it generally going down? You then trade in the direction of that trend. To follow a trend, you can use charts. Charts show you the price history. You can look for patterns. If a currency pair is making higher highs and higher lows, it is in an uptrend. You might look for a chance to buy. If it is making lower highs and lower lows, it is in a downtrend. You might look for a chance to sell. Moving averages are simple tools. They can help you see the trend. A moving average smooths out the price data. It shows the average price over a period. Another simple approach is range trading. Sometimes a currency pair trades within a range. It bounces between a high price and a low price. The high price acts as resistance. The low price acts as support. In range trading, you try to buy near the support level. You try to sell near the resistance level. This strategy works well in markets that are not trending strongly. You need to identify clear support and resistance levels. Tools like Trendlines can help here. A very important part of any strategy is risk management. Always decide how much you are willing to risk on a trade. Use a stop-loss order. A stop-loss order automatically closes your trade. It closes if the price moves against you by a certain amount. This helps limit your losses. Also, think about your take-profit level. This is the price where you will close your trade to take profits. Having a plan for entry, exit, and risk is crucial. These are the fundamentals. Section 8. Avoiding common pitfalls. Smart tips for beginner traders. Many beginners make similar mistakes in Forex trading. Knowing these pitfalls can help you avoid them. One common mistake is trading without a plan. Some people trade based on emotions, or they follow random tips. This is very risky. Always have a clear trading plan. Your plan should define your strategy. It should define your risk management rules. Stick to your plan consistently. Do not let fear or greed control your decisions. This is vital. Another pitfall is risking too much money. It is exciting to think about big profits, but Forex trading is also about managing losses. Never risk more money than you can afford to lose. A common rule is to risk only 1% or 2% of your trading capital on a single trade. For example, if you have $1,000 in your account, risk only $10 or $20 per trade. This helps you survive losing streaks, and losing streaks will happen to every trader. It is part of the game. Overtrading is another frequent error. This means trading too often. Some beginners feel they need to be in a trade all the time. This can lead to poor decisions. You might enter trades that are not part of your strategy, or you might trade just because you are bored. Be patient. Wait for good trading opportunities that fit your plan. Quality of trades is more important than quantity of trades. Remember this important lesson. It will serve you well. Finally, many beginners stop learning too soon. The Forex market is always changing. There is always something new to learn. Keep educating yourself. Read books about trading. Follow market news. Analyze your past trades to see what worked and what did not. Learn from your mistakes. Continuous learning is key to improving your trading skills. The journey of a trader is one of constant growth. Embrace this process fully. It will help you in the long run. Section 9. Your Forex journey, final thoughts and encouragement. You have now learned the basics of Forex trading. We talked about what the Forex market is, we discussed currency pairs and how trading works. You learned about pips, lots, and spreads. We also covered factors that move prices. We looked at basic strategies, and we shared tips to avoid common mistakes. This is a lot of information. Take your time to understand it all. Do not rush into trading without preparation. Knowledge is your first step to success. Starting Forex trading can be exciting. It can also feel a bit overwhelming. Remember that everyone starts as a beginner. Even the most successful traders were new ones. The key is to be patient with yourself. Focus on learning and practicing. Use a demo account first. This will help you build skills and confidence. Do not get discouraged by early losses. Losses are part of the learning process in trading. Treat them as lessons. As you gain experience, you will become more comfortable. You will develop your own trading style. You might find strategies that work well for you. Keep your risks small, especially at the beginning. Protect your trading capital. This is very important for staying in the game. Remember the tips we shared. Avoid common pitfalls like overtrading or trading without a plan. Discipline is a trader's best friend. It will guide you through challenges. The Forex market offers many opportunities, but it also comes with risks. Approach it with a serious and disciplined mindset. Keep learning and adapting. The journey of a Forex trader is continuous. There is always more to discover. We hope this guide has given you a good start. We encourage you to continue your education, trade wisely, and we wish you the best of luck on your Forex trading journey. You can do this with care.